Well, good morning, good afternoon, or good evening, depending on your perspective on the world. And welcome back to another edition of the Trading Coaches Playbook. This is Brandon Wendell with you. And basically, we got a few special guests with us today. So I'm going to go ahead and introduce them in just a moment. But before we get started, just need to remind you that we are not broker dealers or investment advisors. And we're going to take a look at this information, but from an educational standpoint only. I'm not telling you to buy, sell, or hold any particular securities, give you personalized recommendations about the markets. Keep in mind that the markets do involve the risk of loss. This is always a situation. No matter what we can do, we can never eliminate the risk. All we can try to do is minimize that risk. And we are not subject to trading restrictions, so we have a position as security initiate one at a time. That being said, let's see. Welcome, Sean. Welcome, Kevin. Welcome, Helen. Welcome, everyone. Suzanne. And we're pretty busy here. As you can see, there's quite a few things going on at Wealth Builders HQ, and probably keeps us out of trouble that way. I myself am in charge of quite a few programs. Obviously, we have the Trading Coaches Corner that we're going to be going over today. And my topic for today is risk management, which is a very important topic. Just out of curiosity, does anybody enjoy losing money? Yeah, see, nobody ever raises their hand. If I ask who's good at it, then I get a bunch of hands. But no, nobody enjoys losing money. So we want to do what we can to protect our money. And that's what risk management is all about. I mean, you can never eliminate risk. It's going to be there, but we can manage the risk that we face. Anyway, before we get to that, again, you can stay in touch with us through social media and a bunch of other stuff that way. I mentioned the courses that I'm in charge of. I've got the Futures Boot Camp for those of you who are brand new to trading, SPX Cash Flow for those people looking for additional cash flow opportunities using options on a daily basis. I also am involved in longer-term wealth building using wealth with spreads. And then we'll talk a little bit more about the program, the E-mini Think Tank today, where we practice a lot of risk management, and I covered a lot of these concepts that we're going to talk about today. But before we get into today's topic, I want to introduce somebody who is here and give him a few moments, take the mic, whatever. Anyway, Sean Reed is a friend of mine. I think I can call him a friend. I've known him for quite some time. He actually knows my wife as well. And we all used to work together, and it's kind of nice to have him back in the fold, if you will, here at Wealth Builders. So I'll go ahead and shut up for a few moments. And Sean, if you want, I don't know if you want to share your screen or anything, you can have the mic. And,
absolutely. Can you hear me?
Yeah, I can hear you, definitely.
So I think it's a little deeper than that, Brandon. Yes, we're friends, but like our generation, not the millennials, I'd go as far as say we're homies, if that makes any sense. Anyway, and I'm glad to see you got the beard going. That's pretty cool. Me too. Anyway, you can't see mine because it's ginger beard / gray, but you know. Anyway, so you can hear me. So yeah, I just want to take a few minutes. They wanted me to jump in on your session. Thanks for having me, and just kind of introduce myself, tell you what I'm doing, and any quick questions I'll take probably 10 minutes of your life if that's okay.
Yeah, go for it. Yeah, it's all yours.
So let me share the screen real quick.
Yeah, here you go.
And so I'm relatively newer to Wealth Builders, but I don't feel like I'm new to Wealth Builders, but I don't feel like I'm a new kid on the block, if that makes any sense. And hopefully you can see my screen. This is me. This is me clean shaven. Look at that. Anyway, the younger, sexier version of me. It wasn't too long ago. This was like 4 years ago. Anyway. But I've been active trading since 2001. I've mentored thousands of traders like Brandon. Brandon and I have very similar origins. And we worked together, quite a bit in the past as well. I've been a floor trader, so I've been a proprietary firm capital trader, 20-to-1 leverage on equities back in the day. Woo, fast times at Ridgemont High. I've also had my own trading floor. I had a trading floor in Scottsdale. It was a licensed trading floor. I had 25 guys and gals underneath me, and we were an active day trading floor on stocks. And that was my beginnings to options. We created these faux synthetic long positions with options so my traders could short on downticks. So that kind of dates me a little bit on my introduction to options. I had to get licensed and be an option principal to be able to put these option positions on for my traders, so they all could smack short stocks on downticks, day trading. That's kind of a fun little factoid about me. Towards the end of that tenure, I got fed up with dealing with the traders not wanting to follow the rules. I walked over to Schwab. They didn't know what to do with me. I was in my 20s. I became a senior broker on the fanciest team with Schwab within a short period of time. So I was a senior broker with Schwab for, better part of 5 years. Then I worked on the institutional side, towards the advisory side. So I'm kind of a mixed bag. I've got the day trading background, but I also have the advisory, wealth building. I've had 9 security licenses in my past life, all these things. So enough about me. I just wanted to take a moment to just kind of explain what's going on. So Brandon mentioned the courses that he has going on. I have the pleasure of delivering Vegas Spread Mastery, and it's a little bit more geared towards weekly spread trading. But then I'm a little bit different, and Brandon will attest to that. Not the fact that I'm a ginger, I'm a redhead. All jokes aside, the way I approach spreads is very different than most people. And the way I approach it is very similar to the way pit traders do. So the only circles that I've come across that are similar are, and Brandon and I have some mutual friends that are ex-Chicago pit traders. And their expression, it's all about the Vega, all about the Vega. And what they're talking about is not just timing their options, but then, being picky with the premium that they enter, even if it's a spread. And so for those of you that are newer to spreads, this is just kind of a down and dirty cheat sheet that I'm sharing. This is a credit spread. We could sell a call and then buy a call above it. This would be a call credit spread. And we'd initiate this trade if we think the trade is going to go down. We could do inverse of that would be a put credit spread, which would be selling like 35 and then buying a 30 here. And this would actually be a bullish transaction. And where most trading books talk about, they'll find a spread. You pull up an option book, or you pull up a premium, you pull up an option chain, you find a spread good enough, and then you jump in. But a lot of people don't know they might be accepting the lowest premium that the spread has been in the past week. And I don't know if any of you have ever sold options. The moment you sold it, it immediately went against you, and you had to sit in the thing for 3 weeks before time decay finally forgave you for a terrible entry. So I don't know if I'm preaching to the choir for any of you, but my jam is to be picky with your premium. So it's not just timing the underlying ticker, it's also being picky when we jump into our spreads. And so I have a couple more little slides here to share. So another thing that I share with my students is to not only identify a spread, but also we can actually select strikes away from the pivot. So in this case, this is US Steel. We found a major pivot kind of at 25. I'm the guy to teach you, well, we could sell a 24, buy the 22s, and do a 2-wide put credit spread, right? And then I'm going to teach you how to be picky with your premium. So we wait till the stock has a bad day, essentially. Then we'll put on this trade further out of the money, but then still getting the yield that we're looking for. Okay, so that's kind of my jam. And, the premise being is that not just being picky with your underlying, but also being picky with the premium. It's usually a game changer for people. There's no guarantees in life, but it was a game changer for me probably 15 years ago when I started to pay attention. I haven't seen this in a whole lot of books. I don't know if Brandon has ever come across this. The only place I've come across it are just rubbing elbows with ex-Chicago pit traders. And what we're seeing on the next slide here, this is Tesla. And I charted the premium on a 5-wide put credit spread on Tesla. And you can see the premium has wiggled even in the past, 3 or 4 days. Actually, no, this is the past 5 days over here, but look at the premium wiggle. It wiggles from $3 down to 50 cents. So I'm the guy to teach you how to take advantage, when to enter into these trades. So we're keeping the same strikes that we pick, the out of the money strike, but then we're going to cherry pick when we jump in on our premium. And so this is all what we do. We run portfolios. We, have a portfolio running, and it's not just jumping into trades. It's also letting the trades run, and then also managing the trades when they look amazing. We're managing the trades when they go against us a little bit. And it's kind of inclusive, kind of day in the life of a weekly spread trader. And that's what's happening in that Vegas spread mastery. So I guess I spit at you quite a bit. I threw a lot at you. I'll shut up for a second. Is there any quick questions? Or does Brandon have any comments? Comments or questions? And you can type in the chat if you'd like.
Yeah, there's one showing up there, Stephen W.
Steven's saying, does any platform show the changes in premium real time? The answer is yes. I know Thinkorswim would. The only problem is that options are a little bit less liquid, and specifically spreads. Spreads are even less liquid. But yes, I know, for instance, Thinkorswim does. Another one to chart spread premium real time would be Interactive Brokers. Those are the only two brokers that I know that you can chart spread premium that would be, in theory, ticking real time. And like this, what you're staring at is from Thinkorswim, and it's charting spread premium. Tasty Trade, I don't know if you can. I don't have an answer for you there. Tasty Trade, they built it pretty slim. Tom Sosnoff built it pretty slim. So some of the bells and whistles like you might have with TD Ameritrade or Thinkorswim or with Interactive Brokers, you don't with Tasty Trade. I doubt it. I could be wrong on that, but can you put a stop loss on a spread if you wanted to? A lot of people don't use stop losses on spreads because they cater the spread width to the risk that they're willing to take. And, you know, something to think about. The banks and institutions don't use stop losses. They'll just cater the spread width to what they're comfortable on the risk management, because a credit spread is a defined risk trade. 5 wide and 5 days. 5 wide would be the difference of the two strikes. So we can see the 45 versus the 40s here. That would be a 5 wide. So you're selling the 145s, buying the 140s. That would be known as a 5 wide. And then the premium over 5 days. This is showing you the spread premium range the past 5 days. Hopefully that makes sense, Brenda. What about a debit trade instead on Tasty? Well, you can do debit trades. Debit, we structured a little bit differently. Debit, you can do single leg debit or a debit spread, but it needs to be in the level first, or in the zone first, or at the support and resistance first. So you still need to time your debit, but we don't necessarily track the premium. We track the level or the zone that the debit spread would be in. And we do a little bit of debit. So dominantly in the Vegas Spread Mastery, it's dominantly credit spreads. We do some debit, you know, if the group, you know, kind of takes me there in our sessions. Could you place a stop on a debit? Sure. And a lot of people enjoy 50-50. So a 50% decline in your debit could be a consideration for a stop loss on the debit. If that makes any sense. So I guess I could call Brandon out. Have you come across a book anywhere, Brandon, that talks about, you know, taking advantage of your premium and timing your premium? I haven't come across one. Have you?
No, I don't think I have. I mean,
Again,
no.
the only places I've come across are just the buddies that I've had, you know, like Greg Hadley, you know, he, you know, a pit trader, you know, handling the SPX option orders for Goldman, you know. Anyway, yeah, but he talks about all about the Vega. It's all about the Vega. And that's what those guys are talking about. It's being picky with your premium when you're doing your spread.
Yeah,
Yeah,
I don't
5
know.
wide would be a $5 difference. Exactly, Brenda.
Yeah, I was gonna say, Paul, I actually have videos I created in my programs on how to place those stop losses in Tastyworks. It's in my SPX program. So yes, you can place those stops, especially on the debits. Not as Sean was saying, you don't really need them on the credits because you got the max risk kind of settled with the spread itself.
Absolutely. Well, cool. Short and sweet. I don't want to take up too much more of your time, Brandon. Hopefully, you know, I said a few things, got some curiosity, and I do my sessions Monday, Tuesday, and Fridays. So I do it 3 times a week. Be there, be square. We do 2 hours a clip, and we also record all our sessions for the Vegas Spread Mastery. Anything else you guys have for me? Well, cool. Nice to touch base, and hope things are good for you, Brandon. And yeah, we need to catch up anyway. Cheers, man.
Yeah, absolutely. Thanks for being here. I appreciate it.
All right. Thank you all, everyone, for letting me jump in.
Yes, this is being recorded. Let me go ahead and I'll share my desktop. So thank you, Sean, for being here again. He's got Vega Mastery as his program. And I'm going to go ahead and start my topic for today, which, if you saw the advertisements, is on risk management. And basically, when it comes to risk management, let me get the chat here going. There we go. And there we go. All right. Make sure everything's set up. So Sean ducked out here already. Cool. Anyway, yeah, he and I have worked together for many, many years. And like I said, we're homies, as he said. So anyway, getting back to risk management, there's really kind of three main things when it comes to risk management. I'll type this in here. And of course, you can feel free to do screenshots of my notes. That way you've got them for yourself. But when it comes to risk management, I call them, I guess, the three pillars of risk management to kind of really help you. And honestly, this is the only thing we have control of when it comes to the markets. You cannot control whether you're going to win or lose, right? And you can't control how much you're going to win if you're right. But what you can do is control how much you are going to lose if you happen to be wrong in the markets. So that's what we definitely need to do, is try to control our risk. So I'll just say, loss or risk is the only under our control. It's the only thing under our control in the markets. And basically, there are three main ways to manage that risk. Number one is size. Number two is duration. And number three is frequency. Oops, typed in three. I mean to do that. There we go. Size, duration, and frequency is really what it comes down to. Those three main things to control risk properly in the markets. And too small. Oh, the font here. Let's see. We can do this. I think that's better, right? Hopefully. Anyway, so actually, let me enlarge it more even. Go to about 250 if I can. There we go. All right, so much better. Anyway, size, duration, and frequency. And by the way, this works on pretty much any market you deal with in the world. Those of you who know me know that I've been trading pretty much everything. I've traded Forex, I trade futures, I trade stocks, I trade options. For the most part, as I mentioned before, the main programs that I'm involved with, I have the E-mini think tank. And in the E-mini think tank, we deal with futures primarily. It's futures trading. And we do deal with multiple time frames. So we'll talk about that in a little bit as well. But we do some swing trades. We do some day trades. If I go out to, let me see, where is it here? Sorry, I'm working on a bunch of things right now. Think tank tracking. There we go. April. Actually, I have May open as well. But I track everything we do in those trades. And you can see, if I can enlarge this more. Again, it's covered up. I don't know why. But you can see when I go into these individual trades and track them, they're going to be all different time frames. Actually, it's not even going to show here. I'll have to show it somewhere else. But you can see that some of these are going to last more than a day. Like, for instance, this was a short on the Japanese yen. We entered on the 19th of April, got out on the 20th of April, and it was a win. Some are day trades. Some of them are a little bit longer. Here's another trade on the 30-year Treasury. Got in on the 20th of April, got out on the 24th. So, and the main thing that we need to do, though, as I mentioned before, is control risk, because we're not going to be right all the time. As you can see, I was right 76% of the time on the trades I actually took. That's still pretty good. But one of the key things is look at the size of the win versus the size of the loss. It's almost double. Not quite. And I want to get there, obviously. And then actually, if I go to the May, and this is May's tracking sheet. And again, let me enlarge this as well. Looking at those trades, we actually had a smaller win percentage, 67% versus, what do we have before? 76%. But I ended up doing a little bit better. Oh, no, not better. It was a little less. 17,000 profit versus 14,000. But here's the key thing, why we can do better when we have less winners. And it's right here. The average win is $982, while the average loss, $432. So we did greater than 2 to 1 on that ratio. So one of the things that we can do to control risk, as I mentioned, is size. And when it comes to size, that could be the type and the number of securities traded. Okay, so when we look at things like a type, we have in futures, for instance, you have micros or minis or standard futures. And you also have that with Forex as well. So you could trade micro Forex lots, you could trade mini Forex lots, you could trade standard Forex lots. If you're trading shares of stock, you got one size, but you can trade 1 share, 10 shares, 100 shares, 10,000 shares. So obviously, if you increase size, you increase risk exposure and reward. I should say potential reward. Okay, so risk and reward always go hand in hand. You can't have one without the other. If you want to increase the amount of reward potential in a trade, you have to increase your risk exposure. You can't do anything about that. You always have to take on more risk to get more reward. If you reduce your risk, by nature, you're going to also be reducing your reward. So you can't have one without the other ever. So we have to choose. And by the way, when it comes to these choosings, you can choose whatever size you want. It may not be the same thing as somebody next to your neighbor or your friend or your trading partner or even your instructor. It may not be the exact same. Everyone has their own individual risk tolerances and styles that they like to trade. You need to find the one that's best for you. The way I look at this risk management, it's kind of like a radio. And I'm not talking about digital. I'm going way back old school, with that 8-track player and FM and AM radio. You used to have dials on those radios, right? And what you need to do is you got to dial for size or volume. You've got to dial for frequency. You got all these different dials, and you have to dial in what's right for you. And not everyone is going to have the same settings as everyone else. So let's see, are you trading the options or the future? It depends on what it is I'm trying to do. When it comes to the futures markets, traditionally, I'm trading futures themselves. I mentioned the E-mini think tank. That's where I do futures trading. We do swing, a little bit of position, and day trading. Okay. The other program I have is called Wealth with Spreads. And there we're doing spread trading on futures. Okay. No options there. Actually, every once in a while in the E-mini think tank, we do talk about options. I do modules every now and then on that. And so like I said, these are the different programs that I have available. Let's see, we'll do that. So E-mini think tank, and that's again, trading, active trading of the futures markets. And that meets 3 times a week. Monday, Wednesday, and Thursday, 9 a.m. to 11 a.m. Eastern. Okay. Now with the Wealth with Spreads program, that's a little different. We don't actually meet on a regular basis. Actually, we do. We have a Q&A session every other month. So live Q&A. But basically, it's a video, weekly video with trade ideas and real-time SMS updates on the trades. The SPX cash flow, that is an options program. I basically trade weekly options on a daily basis to generate cash flow. So we sell premium. And we are trying to have an option expire every single day and capturing some premium on that. And then the last one is the Futures Bootcamp. And that is for beginning traders. It's basically an intro to the futures market. Teaches you how to trade them. So there we go for new futures traders. So getting back to the risk management. So those are the programs basically that I have. If you got any questions about those, you can always ask me, of course, or also email support@wealthbuildershq.com. And I'm always available too to my students. You know, when you log into these programs, for instance, if I go into my Wealth Builders, there it is, E-mini Think Tank, you can see I've got a lot of materials in here for my students. We have monthly trade trackers. Actually, that needs to be updated. I just emailed the new ones in, so they should be posted soon. But I have these bonus videos that are educational videos, and I have documents that support all of those educational pieces to teach you how to trade the way I trade. And then you can always reach me by sending me a message. Okay. Now, the one, actually, there was a question that came up earlier about setting stops on Tastyworks. I just want to show you SPX Cash Flow Secrets, educational videos. There it is, trading using Tastyworks. I actually have a video that I created. So if you become a member of the SPX Cash Flow Secrets program, you get access to all of this. And by the way, there's a 2-week free trial if you'd like on any of these programs. So if you go into that video, I actually have step-by-step how to set up stops using the Tastyworks program. So that's in there. Anyway, getting back to the discussion at hand here, going back originally, when it comes to risk, the first thing that we should really focus on is size. Okay, at any time, let me see here. I'll put that first. You should always adjust the size first. If you're ever having problems with your trading and you need to kind of stop and reset yourself, or you got to figure out what the heck is going wrong, you're in kind of a losing spiral, downward spiral, it usually feels like, you got to stop what you're doing. And when you go back to trading, reduce your size. Okay. And here's a reason why. When we start losing money, psychologically, we try to get it back. Okay, even though we may know that that's the wrong thing to do, we're not supposed to do that, we still try. There's something in the back of our head that says we need to get back what we lost. We start to revenge trade. We make emotional decisions that hurt what we're doing when it comes to our trading. So one of the best ways to combat that is to take the revenge out of the equation. If I normally trade one standard contract of the S&P futures, and I stopped trading because I've gone through a series of losses and I've hit my limits, if I go down to one micro contract, can I make as much on that one contract as I could trading a standard? Probably not, right? I mean, I could theoretically if I held on for a big move, but the likelihood is extremely low. So by chopping down, excuse me, dropping the size that I'm trading, I've taken away the ability to revenge trade in trying to get back that money. Now I can simply focus on, am I making a good trade? Am I following my rules? Am I getting back to my basics and doing what I'm supposed to be doing? So that can be very, very important to you. At any time, if you're struggling with your trading, cut your size back to a minimum so that way you cannot be revenge trading. If you make money, great. But that's not what you're worried about. You're making sure that you're first stopping your losses and trading in the right way, according to the rules. You know, if there's an adjustment you need to do on your rules, again, cut back the size, because that way you cannot try to get back what you had already lost. So if you increase your size, as I said, you start increasing your exposure to risk and your potential reward. Ease into it. Take small steps. This is not a sprint. You know, trading is not a sprint. I should say it's trading. It's more of a marathon. You know, we want to be successful over the long period of time. We're not trying to get rich quick. And if you are, you're in the wrong business, because that's not what this is all about. It's about becoming consistently profitable in the markets. That way, when we go to the markets, we know we have a high probability of taking income or building our wealth as we're trading in those markets. So we're not trying to get rich quick. We want to build up our skill set and our wealth over time. So one of the ways we do that is to increase our size gradually. You know, I've seen a lot of people who were doing one micro contract and they started doing really consistently well. So they went to 2 and then they'll go to 10. It's like, whoa, wait a minute. What happened to 3 or 4 or 5? You know, take some small baby steps, because every time you increase your size, you're increasing your risk, and that changes you psychologically. It has an impact on you. When you see those profit and loss numbers jumping in bigger increments, it does something to you. Even if you don't realize it, it does. So we want to take small gradual steps and build up to increased risk in the markets. Now, duration is how much time you're spending in the trade. Right? You're actively in a trade. And this is really kind of a function of the chart time frame. Right? If you use intraday charts, you're probably going to be in your position for a lot less time than if you use daily charts or weekly charts or bigger time frames. You know, we can go all the way down to share charts. And those can offer less risk. There are 3 different ways of creating charts. You have time-based. So let me just do this. Chart creation. Again, we got time-based. You've got volume-based or share-based. And then you've got tick or trade-based. Okay. And you can choose which one you want. It's up to you. Oh, thank you, Butch. Take care. Anyway, you can choose which one you want. The funny thing is, a lot of people say, okay, well, which has more risk? Day trading or swing trading or investing? And the answer is yes, right? The longer you are in the markets, the greater the risk you face. But of course, you have greater potential profits. Goes hand in hand. So first of all, we take a look at these charts, time-based charts. Oops. Man, I got way too many things open here. So going into my charts here, I'm looking at the S&P 500 on a 15-minute time frame right now. And that means every candle is 15 minutes of time. And no matter what happens with the trading, even if there's no trading that occurs, there has to be a new candle made every 15 minutes, period, because it's time-based charts. But if we change this chart, let's see, can I do this here or not? I forget. I don't think I can do share-based charts here. So I might have to open a different program for that, but that's okay. Let's do that real quick if I can. Yeah, it doesn't let me do shares. So I thought, but if I open a different program, I might be able to do that. So what I can do then is create where I get a new candle every time a certain number of contracts have been traded. So if I do 100 contracts, every time 100 contracts get traded, I get a new candle. The nice thing about that is it has nothing to do with time. And you'll see that when I create one of those charts, it's not symmetrical when it comes to the time. Okay. It allows me to create the charts. Okay, it's finally opening up. Takes a little while. Actually, it's going to need to download some data first. So I'll take a moment. Yeah, it's all right. Or again, you can either have time-based or you can have trade-based, and a certain number of trades that come through, and that creates a new candle for you as well. I actually like those a lot. And by the way, you can use those share-based or time-based on longer term swing trades as well as day trades. You just adjust the number of contracts you're seeing. So again, hopefully this loads up pretty quickly. Yeah, it's still updating. I wonder if I can, no, I can't do it on my other program. Let me close this one out anyway. Exit. I have a lot of programs open here. So anyway, taking too much time. I'll keep going with this. So as I was saying, we'll come back to the charting in just a little bit, but frequency is the number of trades taken. Yeah, basically, the more trades you take, the more likely you are to take a bad trade. So basically, we need to be selective. Only trade if it follows or if it fits our rules. What did I do there? And only trade if it fits our rules. Okay, that's fine. So if we take a whole lot of trades and we're not very selective, we take every single trade that comes along, we are likely to take a lot of bad trades and unnecessarily risk money, maybe even lose a lot. But if we're more selective, we are only taking high quality trades that really meet our criteria. They look very, very good and they should work, they have a higher probability, then we're going to be doing better. There's only one person that does really well when you take a lot of trades, and that's your broker, right? Because they make money on the trades you take, whether it's commissions or spreads or whatever it may be. They benefit the most when you overtrade. And there's no reward for taking the most number of trades. We get rewarded by taking the right trades and making profits. So what happens when it comes to trading in general, again, we were talking about day trading versus perhaps swing trading, perhaps what we call position trading. Yeah, those are all different styles of trading. Let me fix this. Is it still going? That's still updating. What happened here? Delayed data update. Okay. Figure something out there. Anyway, when it comes to these three different styles of trading, if you will, we have day trading, we have swing trading, and we have position trading. We basically can adjust our risk to whatever comfort level we happen to be. That's what I was saying. Not one is necessarily more risky than the others. Day trading, we obviously have high frequency. Okay, so if we have high frequency, how do we reduce our risk? Well, we can do lower size, right? And we obviously have lower duration. As I was talking about with the duration, if we use a smaller time for our charts, we're likely to have smaller zones, first of all, so that's less risk, but we'll also have the zones closer together, which also means lower reward. So even though we have high frequency, which means greater risk, we now have lower size, which is lower risk. And because of the lower duration, again, we also have lower risk. Well, if we take a look at swing trading, as I said, now we might have medium frequency. It's probably less than what we had with day trading, Actually, let's see if I can do this. Nope, shape. Anyway, so we got medium frequency. We have a little bit medium, I say, size, which of course is increased risk compared to what we had with day trading. And we have medium duration. So when it comes to the position trading now, we have very low frequency. And therefore, we have a low risk there because we're not taking as many trades. But because we're taking fewer fewer trades, we can increase size, which means increased risk. And we don't have to go gigantic, but we can definitely increase our size because we're taking fewer trades. And we also have increased risk because we have large duration. So we have increased risk. Just what I do there. So basically, when it comes to our risks, obviously with day trading, we have that high frequency. So our risk is high there, but we're lowering the risk on these other pieces to make up for it. And that's what we have to do. We have to figure out which combination is best for us. In the middle, it's kind of medium everything. Meanwhile, here, now we have low frequency for low risk, but we've increased our size. Oops, can't do that. And our duration, and we have increased risk there. So, when we look at it this way, which one has the most amount of risk? None. They can all be the same amount of risk because with the day trading, because we're making more trades, we lower our size and duration to offset that risk. Meanwhile, here we have a low risk because we're not making as many trades, but we do have increased risk with the size and duration. So we can adjust it by using those three pillars, either frequency, size, or duration, to get the kind of risk that we're comfortable with. And that's why when people say, well, what's more risky, day trading or swing trading or position trading? I always tell them, yes. There's not one that's necessarily more risky than the others. It's in how you approach them and how you manage your individual risk. So let's see, did that chart finally load up? Yes, it did. So now if I go live here, I should be able to change my charts. And I'll use the NASDAQ as an example since I have that here. As soon as it loads up, so we're good. So for instance, I'm on let's do an intraday 15-minute chart, or actually I did 5, that's fine. So here's a 5-minute chart. And what you notice about this, remember, we're talking about time-based charts versus other styles of charts. So looking, and actually while I'm here, I'm gonna do this too. I need this one open too, to show you a difference. And let me clean up my chart here. Actually, I do 115. It's a little bit easier to see. All right, and this one here. And that's loading up. Okay, so right here, we got a 15-minute chart of the NASDAQ futures. It's actually the micro NASDAQ, and it looks pretty decent chart. You can see that we're going back about a day and a half here of time. But as I was mentioning, even if we have a very thinly traded security, you're still going to have a new candle every 15 minutes because it's a time-based chart. But if I change this chart, I go to custom, and now we go intraday volume. Actually, I have both available here. So let's say intraday volume, we do 500. What that means now is I only get a new candle every time there are 500 contracts traded. Okay. And what you're going to notice, it actually brings it up. It's kind of weird. It's not giving me my scale on the bottom there. It's weird. don't know if it's cut off or what. Come on. Let's try 100 volume. See if that works. I'm just trying to get my scale on the bottom so you actually see it. And it's really weird that it's not showing it right now. But the time is not set up the same way as it was. Actually, I think my chart froze a little bit. There we go. So for instance, here, come on. Why is it got to do this to me? But anyway, right there, that's 1644. So 4:44 p.m. yesterday on the 1st. So if we're looking for a full day's worth of trading action, actually, it's not even updating. Hang on. Let's go NQ. That's the problem. Do the full size. And again, it's not updating. Okay, we'll try something different then. I was having some issues with this platform the other day with some of the data feeds anyway. I just wanted to demonstrate and show you how the time at the bottom will not be symmetrical when you go to share based. So now I'm on Kansas City wheat, and again, a 15-minute chart. But if I change this chart from 15-minute to a volume chart, and I'll just do 100 contracts. Let's see if it shows that. Again, it's not updating quite right. There it goes. Now you'll see at the bottom, that's better. The time is not symmetrical. 12:30, 9:49, 9:47, 9:46, 9:43, 9:41. It's just random. The time, some are a couple minutes apart. Some of them are, right here, 9:49 a.m. It jumps to 12:30. And that's because there was just not enough volume to create another candle. So we only get a new candle when there is 100 contracts traded. Actually, we'll do this. We'll do 10 contracts, and I can zoom in a little more now. And you can see that I'm getting a new candle almost every minute at this point because it's only 10 contracts. But if I wanted to swing trade with this, all I have to do is increase the size. Let's say we do 1,000 contracts. And now I'm looking at multiple days. Okay. Or as I said, instead of the number of contracts traded, we can go out to custom and do number of trades. So if we get 100 trades accomplished, we get a new candle. But again, this is not based on time. So if you look at the time at the very bottom of my cursor, 9:40 a.m. Next one is 9:45. Then it goes 9:47. 12:30, 12:39, and it just skips time. So we can do different styles of charts to adjust our risk as well. Oh, great question. Andre is asking, do technical analysis concepts apply to ticker volume-based charts? Absolutely, they do. And as a matter of fact, it can be a little bit better sometimes. Let me go here real quick, and we'll take a look at gasoline, since I have that here. Right now, I'm looking at the July contract of gasoline on a 15-minute time frame. Need to clean this chart up. Okay. And we would look at things like support and resistance or supply and demand. And, for instance, we actually have, I think, a little rally point right there. Might not be the best. Oops. There's another one right here. Now, the one thing that I don't like about this is it's time-based. I prefer to use share-based charts or volume-based charts. The reason why is I'm looking for the origin of imbalance. And you can actually see the imbalance when you look at those share-based charts. Let me show you. Actually, this one will go tick. And let's just say I'll do 233 ticks. Looking back just a couple days. So here we are on gasoline, and we actually get almost the exact same chart. But now what we're seeing is every single one of these candles is 233 trades that have occurred. So what we see is larger candles. Those larger candles, remember, every single candle here is the same amount of trades going on. But why do you get those larger candles versus smaller? Because of the imbalances between the buying and the selling pressure. Okay, so in this case, in order to get 233 trades, we actually had to have prices rally quite a bit. Why? Because there's no sellers in that area and there's a lot of buying pressure. So again, I don't really care as much about the trades because we don't know if each trade was one contract or 100 contracts. That's why I like going here. Say we do this. RB July. Heck. Oh. And now, yeah, we could do custom volume. Now let's do 100 on that for now. And this one I really like the best. And here's why. Each one of these candles has the exact same amount of volume, but they're not the same size. Why? Again, imbalances between buying and selling pressure. So right here, we have an area of demand that looks pretty good. And we may end up bouncing off that. We might not, I don't know. But looking at this, you can see we have basing and a very large rally there. Remember, each one of these is 100 contracts being traded. But why was there that big jump? Because in order to get 100 contracts purchased, we didn't have any sellers in the area. That buyers had to become very aggressive and raise their prices up quite a bit. So to me, this is going to show you supply and demand imbalances much better than almost any other kind of chart. As I said before, this could be for day trading if I use a small number, but what if I did 10,000 volume? Now we're looking at swing trading, aren't we? Because in order to get 10,000 contracts traded, and again, let me clean this up. That might take days or weeks. But what will happen is we'll start to see these areas jumping out. It may not even be the same as what we would normally expect for zones. Right here, if I zoom in there, you'll see we didn't really have good basing there, but notice that's a large candle compared to all the other candles around it, right? Why is that candle so big? Because in order to get 10,000 contracts traded, the sellers had to be aggressive because there's no buyers in the area. They had to drop their prices down dramatically. So if they got all their contracts filled, that's fine. But the probability is high they couldn't get all the contracts filled. So there still may be an imbalance in that area. And if we return to that area in the future, we're likely to see a sell-off once again. That's kind of what happened there. Didn't hit exact, but it was pretty close. So I actually like looking at these for longer pictures. Again, if I go out to, let's say, ES, June contract, I'm still on 10,000 contracts. And unfortunately, it's not quite updating, but you can see this is back to June 1st right here. Actually, all this is June 1st still. This is a very heavily traded contract. So I might have to go with a bigger number for a swing trade. Let's do that. Let's do 100,000. See how that looks. And again, I'm going to look for origins of imbalances, and they definitely do show up from time to time. I don't really have anything I could trade right now because we're just still rallying, but you can see we definitely have drop, base, 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 and rally. Rally, base, rally right here. So yeah, I like that, and they definitely do work. So again, going back to our style of trading, if we use either time-based, that's fine, or we can use volume or tick-based. The smaller numbers we go to, the more trades we're likely to take, and the smaller duration we would be in the trade. But if we go to larger numbers, we have more time before we hit our targets. We usually take smaller trades, or sorry, fewer trades, and adjust our risk that way. So as I said, we basically have three ways of adjusting risk. We have size, duration, and frequency. So the first one to always adjust if you're running any problems is your size. If you cut back the size of what you're trading, or even go from standard to mini or micro, you reduce your risk. And the other benefit is you take away that revenge trading. So you cannot possibly revenge trade. If you spend less time in a position, there's obviously less movement that can go against you or for you. So you reduce your risk and your reward. So duration is the time spent in the market. Less time, less risk. More time, more risk. And then frequency, again, we don't want to just take any trade that comes along. We want to be very selective. You'll notice in the E-mini think tank, in my tracking sheet for this month, I had 59 trade ideas that we never took. For whatever reason, they didn't meet my criteria. I actually have them all listed here. We hit our target before entry. RSI was too bearish. We had too much bearish momentum. RSI was too bullish. We had too much bullish momentum. We closed below a moving average. Whatever was going on, the reasons are there. And I do not take a lot of trades. I want to take the right ones, and that's it. We had 19 winners last month in the E-mini think tank trade ideas. And as I was saying, let me see, where's there? I open up. Let's pick this one. This is our trade ideas. What happens is every day before the class starts in the E-mini think tank, I produce this worksheet and it gets emailed out to the students as well. So you can see these were the trade ideas we were looking at for that day. May 31st, we were looking at taking a long on the NASDAQ, short on the Aussie, short on the Kiwi, and unfortunately we lost on this one, but it was a short on the soy meal. And every trade, I identify the duration potentially based on the type of chart we're using, and this was a lot of swing trading here, as well as the amount of risk, and that's per contract. So we know, okay, here, as a matter of fact, we got a bunch of options, don't we, with the NASDAQ? We could trade the micro that's being shown here, or if we're okay with the amount of risk and want more reward, we could just trade the NQ rather than the MNQ. So it's obviously your choice. And then page 2, I actually had 7 trades on that day, I think. Yeah. So I usually come up with anywhere from a minimum of 3 trades. Sometimes it's May as 12. And what I do is every one of those trades that I show, I track. And actually, I can show you, I think it's this one. Nope, that's not it. Where is it? Oh, yearly tracking. There it is. This is how we've done so far every year. So this is this year so far, 2023. Obviously, May is where it's cut off because we just started June. And you can see we've been doing pretty well. My average win rate so far for this year is 65%. But again, the number of trades that we don't take is huge. 57, 59, 62, 44, 80, 59. There's a lot of trades we just don't take because they don't meet the criteria. We do not want to be taking trades that we have no business taking. And then the other thing I'm very proud of is my average win versus my average loss. Every once in a while, it gets away from me. I actually had a bad month right there in February. It was my worst month of the year so far. It was a great win rate, 73%, but you can see I had an average loss that was bigger than my average win, and I should not have that. If you compare that to my best month, which was January, I actually won less. I had 73% win ratio and only made $7,500. Here, I was a little better than 50-50, but I did so much better. Why? My average loss was only $300. My average win was $1,500. And if I go back in time, by the way, you'll see that I typically don't need a huge win ratio if I have a very good win to loss ratio for the average size. And I've never had a losing month. This program started in 2020. July of 2020 is when I started it. And you can see we've never had a losing month. And the reason why is I maintain a good win ratio. Let's see, 2020 was 72%, dropped down a little bit in 2021 to 68%. But again, we made at least a 2-to-1 reward to risk. Did a little bit better in 2022. And 2023, we're also doing a little bit better here, more than 2-to-1. Well, I guess it's about 2-to-1 reward to risk. So that's what I try to maintain. Anyway, if you want to take the screenshot on these notes, frequency, size, and duration, those are the 3 things that we're dealing with when it comes to this risk management. It's the only thing we can actually control in the markets right here. The second part, and I was saying, we can have risk and we can be risky in any one of these styles, but we can adjust the other pieces. So if you are taking a larger duration by position trading, you can adjust the risk by taking smaller size or increase the size if you want to take on more risk. And you're just going to find out what's right for you. So I don't know if anybody has any questions regarding that risk management and the 3 pillars. If you do have questions, obviously I mentioned that I'm also available in the courses. If you're interested in joining me in the E-mini think tank, there's 2 ways of joining. We have a monthly subscription, but then there's also a quarterly subscription. So if you do the quarterly subscription, there's actually a 2-week free trial. You get to try it all out without any kind of risk. Yeah, the first part right there, you go, Chip. So if you're interested in joining us, we can put the link up there. And as I said, if you do the quarterly subscription, then you get a 2-week free trial. You get full access to everything for 2 weeks. We don't even charge your card. So that way, when you're done, you try it out. If you like it, you just let it subscribe and let it charge your card. If not, you just cancel, no harm, no foul. So if anybody has any other questions on anything I went over, please let me know. If not, I want to thank you for being here and spending a little bit of time. Hopefully you enjoyed this and got to know Sean a little bit as well. He's a great guy, and you get to hopefully trade with him as well in the options markets. So I want to thank everybody for being here and have a great weekend as well. So thank you, Kevin. You have a great weekend. Thank you, Brenda. We'll take care, everybody.